Hey, welcome back, everybody. It's Friday, June 14th. I'm recording this about 2 minutes before the closing bell on the 14th. Again, a reminder, this is for educational purposes only. So here's our agenda today. I'm going to take you from the very, very big picture, which sometimes we lose sight over. And then we're going to zoom back into the short-term picture. And then we're going to do a little lightning round. We're going to look at a bunch of charts, maybe for your watch list. And then we'll wrap up for the week. So let's start with the big picture super cycle. I haven't talked about the super cycle since November of 2023. That's when this last bull leg really got underway. So the last video I did in November, the one even preceding that was in June of 2023. And I shared the concept of a super cycle and some of the drivers behind it. So this is a very long-term chart going back to roughly 1940, and it's looking at the Dow. But the concept is, after long basing periods, then there can become a very much a bull super cycle or secular bull. You can see 25 years here from 49 to 67. And then there was a long consolidation from 67 to 1982. And then we had a really incredible bull market from 82 all the way to the top in 2000. And then we had a long consolidation period that went on to about 2016. And then the last low we had with the major low was in 2009, kicking off really what we believe is another super cycle. And if these things tend to run for 25 to 26 years, that could take us all the way out to 2035. And Shavako Capital has also studied this at depth. And one of the biggest drivers of the super cycle is demographics. You know, young people are moving through, spending more money. They're very well educated. And we're currently seeing the millennials in their peak consumption years. And so what the chart was showing back then in June and back again in November was roughly where we were within the super cycle. And we looked at that point in 1988 and roughly in 1957 and said how much meat is left on the bone in this 26-year window. So in doing that, you know, if we were approximately here, the projection was that the S&P 500 still had about 150 to 200% left on the bone to move to 2035 to get to the end of a super cycle. So this is long-term, big picture stuff. But what could that really mean? So looking at some potential targets, you know, here is a chart of the S&P. I'm just showing where we were back in June of 2023, where the S&P was at 4365. Here we are in June, a year later, we're at 5434. That's about a 24% gain. So what we're saying is, in the next, 10 years, 10 to 15 years, we could move all the way up 150% move. Believe it or not, the S&P would be crossing the 10,000 level. And if we got a 200% move, we would be up around the 13,000 level. Sounds kind of hard to believe with the S&P at 5,400, but super cycles can go on for a long time. And usually they're driven by a number of themes. And we have a number of really big growth themes that'll be occurring over the next 10 years. We have artificial intelligence, robotics, the potential of personalized medicine, cryptocurrencies, digital payments, autonomous vehicles. Who knows where we'll be 10 years from now? I do know to get from point A here all the way out to point B up here, there are going to be bear markets along the way. As I mentioned, this super cycle is being driven by the millennials. There's about 84 million millennials that actually entered their peak consumption years back in 2019, and they're forecasted to continue to add to the economy. Now, currently, even the next few years, we've been experiencing over the last 5 to 10 years, boomers are retiring and they're spending more on healthcare. They're buying second homes. They're transferring wealth to the millennials. So there's a lot going on with the boomers. But in addition, as I mentioned, the millennials will be spending money on cars and houses, insurance, financial services, a lot of spending in those high earning years. So it is possible we're going to see another 11 more years of this super cycle. We have strong demographics behind it, but there will be some bear markets along the way. Maybe there's a couple more bear markets. I just use roughly a 3-year bull and maybe approximately a year of bear, 3-year bull, approximately a year of bear, just from history. So it's interesting to look at it this way. There's a lot of potential, and we should be very optimistic based on some of the drivers. Okay, that was the big picture, really big picture. Now let's get back to what's happening today. We're going to look at the short-term picture, and we're going to get into the indices and what's happening with breadth. So last week, and I covered this chart in detail. If you missed it, I think it was an important snippet talking about the divergences. So I'd go back to last week's chart to get some detail on this. But I wanted to turn this week into the S&P. So here's a daily chart of the S&P 500. So I just wanted to break down what's been going on the last 3 weeks, day by day almost. And, we talked about this a little bit last week. This was a big expectation breaker to the downside. We tried to go to new high and we really flushed down. It was really not a good day at all. But what's been happening, we pulled back a little bit, towards the end of May, and we had back-to-back distribution days here. And then the market started to rally. But as it rallied, breadth started to show that it really was not that strong. And we had what I've pointed out here, I call these bad up days. The market is actually, the index is up for the day, but if you look at some of the market internals, the breadth is very, very poor, meaning we have more distribution than accumulation and more decliners versus advancers. So you can see here, 1, 2, 3, 4, 5, lots of bad up days, very bad sign. You can also see as the market really tried to make a move here, we actually moved to new highs on this day in early June. But look, we only had 20 net new highs on the New York Stock Exchange. That is not good at all. Then we tried to move high. We had a bad up day. We had another bad up day. And then we had the Fed this week. So the Fed, we had a gap up. And then we had this stalling action. And we kind of lost some of the gains throughout the day. And you'll notice it really was a distribution stalling day. Even though it's blue, you can see the rise in volume is showing us that there was some churning going on here. And then yesterday, we had another bad up day. The index made a new high, but the breadth was poor. So that's 6 bad up days in the last 13 days. So that is not good. So really, this last 2 weeks has been concerning. Now, in terms of chart reading, this is not your typical situation where you see lots and lots of distribution days. But the subtle chart reading that I'm showing you here about correlating breadth and new highs and new lows, the past 2 weeks have showed some pretty serious market weakness as it looks all okay on the surface with the index rising, but it's really not okay. So this is the S&P, and this is looking at the sector ETFs for the past 12 months, just to try to get a glimpse. Now in the middle here, this is the S&P in black. Now you'll notice that really simple, simplistic, how many of the sectors are above and outperforming the S&P? Well, we only have 2 technology sectors, which is the SMH, semiconductors, and we have the XLK, and we have communications, XLC. In addition to that, the home builders have been also outperforming the S&P for the past year. But there's a lot of sectors that are not as performing as well as the S&P. You can see them there. Now, a couple that look a little bit interesting right here are there is some improving higher lows with the XLRE, which is real estate. Maybe that's looking forward to lower interest rates, maybe in 2025, and biotech, which is more of a speculative XBI index, the ETF. So this looks a little encouraging that they're starting to rise, but there's a lot of weakness. Not a lot is doing better than the S&P. And don't forget, the S&P is also dominated by some of these heavy FANG stocks, and particularly NVIDIA. So let's move to another measure of breadth. This is the New York Stock Exchange Advanced Decline Line. And this is a cumulative advanced decline line. What I wanted to show here is, when the index is moving down, we typically expect the advancers versus decliners. We're going to see it declining. The line will decline as the market's coming down. That makes sense to us as we're correcting. But what we're seeing today, you'll see in the pink box here, is the market is going up. The index is making new highs, yet the advanced decline line peaked out around May 20th. So we've been going for almost a month with deteriorating breadth. Now, this is what we call a divergence. And it could spell maybe we're going to have a correction. We're going to have a correction in price, or maybe it's just a correction in time, and we need to move sideways and consolidate for a period of time. Who knows? It could go all the way into the election. So, these types of divergences, sometimes they completely resolve themselves and the market can move higher. So no one's predicting any doom here. But we also notice that in conjunction with that, there's a lot of other signs of some exhaustion in the charts. So short term, we've had these very extra large splits in NVIDIA and now Broadcom and Chipotle. 10-for-1 splits are large, excessive splits. Those are usually seen towards market tops. So we also have a number of the mega cap stocks that were typically lagging for a very long time have started to move. Apple has jumped out of a long consolidation. Tesla's trying to perk up. Microsoft moved up in the past week, and these have been generally lagging most of the year. And also, the hottest sector out there is the semiconductors, but yet what we're seeing is the laggards in the group, the secondary stocks in semiconductors, start to move up. Names like CLAC and ACLS and the equipment makers. Usually when you start to see the second tier names move up, the laggards, you might be getting to the end of a move, at least in the short term. Again, not predicting anything about a major market top. And I want to go a little deeper in why I don't think it's a major market top. It's not likely that it's a major top. It looks to be, I would imagine we get a correction in price. Maybe it's just a very choppy market throughout the summer, which can be dangerous in itself. These types of divergences can last for many months before signaling a real market top. So let me just give you a couple of examples. So looking back at history, on the right, this is actually the 2007 market top. So you got the AD line in the bottom half of the pane, and then at the top is the actual S&P. And you can see here again, the AD line was topped out for a good 3 or 4 months before the market actually peaked. So these can go on for a long time. The AD line divergence is really a long-term signpost. It's not a precise timing tool at all. You can see here another example. This is in 1998 when we had the advanced decline line coming down for a good 3 months before the market actually peaked. And then we actually did go into a very sharp bear market of almost 30% in 3 months. It was really sharp move. So again, not a precise timing tool, but it's just something we want to keep in the back of our minds. We'll see how it develops. I would imagine we probably go sideways and chop around for a while. So I wanted to go to show basically kind of a lightning round of some charts. So to do that, what I'm going to do is I'm going to try and get my live charts up. So let me try to get a different share going here. Okay, so let me see here. Hopefully you can see my my screen. Let's look at a few charts. So this is Broadcom. We talked about Broadcom a little while ago. The chart is doing very well. It gapped out. Now, again, I mentioned this was kind of a laggard. If you look at the relative strength line, this stock's really gone nowhere since almost the beginning of the year. But it's finally gapped up, had a really good earnings report. So either this is a breakaway or this is maybe a secondary stock that's starting to follow in the footsteps of NVIDIA. We don't know for sure, but the action has been pretty decent. Let's look at NVIDIA. So this is NVIDIA. Now, this is a little bit more concerning in the sense that, NVIDIA has been running like a champ. So NVIDIA has had multiple gaps, 1, 2, 3, 4 at least in this move. Seems to be there may be some exhaustion. You'll also notice that the stock is making new highs for the past 3 days, and the volume is very light. So it's a sell signal, actually. New highs on low volume is a sell signal. It's an early sell signal, so it's something to take note of. Huge 10-for-1 split. It's made a run of 35% in 22 days. The chart looks really good, but there are some signs that it may be tiring. And obviously, this chart has a very large impact on the indices. So with the rest of the sectors not doing well, if NVIDIA were to correct, you can imagine what the general indices are going to do. And it could be a sharp correction. We don't know, but it could be. So here's another one in the group. This is Teradyne. So Teradyne also, this is really a turnaround play. Its earnings and sales are forecasted to turn around. It hasn't been a great performer at all this year. You can see where it's pretty much gone sideways, not done much of anything. But it's had a strong move on a breakout, and it really is something that Bill O'Neill would call up and tight. Came out strong or ran up, then it got really, really tight. Good show of maybe there's some accumulation in the stock. So it's a turnaround play. It tried to break out. It's come back in to test the old highs. So Teradyne maybe is another secondary stock within the semiconductor equipment group. So some other stocks we want to look at are stocks that maybe if we get a correction or just a pullback, they may be stocks that are going to pull back into the 50-day moving average. So here's Kava. Kava's been a leading stock. It's very possible that if the market comes in, it'd be very normal for Kava to come down and the 50-day moving average to catch up, potentially forming a touch, maybe as a buying opportunity. It would be the second trip, which typically is buyable in a big leading stock, or maybe it completely bases out. So we want to keep our eye on something that's strong like Kava. Another one that has been a strong stock in the mix of a market that's been mixed is AppLovin. It's been really holding up fairly well given what we're seeing in some other stocks. It's been getting some support the last 2 or 3 days as it came into the 50-day. So maybe this stock at this kind of the pull back into the top of this consolidation can actually come out of this with a short little cup pattern. The relative strength line, though, is not looking great. It looks like it's starting to break down. So there is a caution sign around this name, but it has been a pretty good performer. Next one is Carpenter Technology. This is a specialty metals, alloy metals maker, and the defense market, the aerospace market has been pretty hot. Interestingly enough, the stock had a huge gap up on earnings, big high volume close, and now it's coming back down. You can see today it's actually come down sharply into the 50-day moving average. And there's this confluence if you draw the line between the high volume close. So maybe this acts as support. We'll have to see how it plays out, but it's on my watch list. Here's Crowd. Crowd, looked really, really pretty ugly 2 weeks ago, but this stock has actually shown 2 big days of volume here, which are really strong days of volume, enough to push it out of this basing consolidation. So that's very, very positive. You'll notice that the relative strength line has finally gotten up. It's the 1 o'clock angle. We're at new highs with the relative strength line. So that's also encouraging. And it just seems to be broken out and kind of pausing a little bit. Many of you know I do have a position in CrowdStrike. A couple others to take a look at. This is GE Aerospace. Stocks had a major move for the most of the year, so it's certainly not early. But what's interesting about this one is it's really formed a flat base, a nice flat base. You can see here a little shakeout down to the 65 EMA line, which is not shown on the chart, but it is right around the 65 EMA. And this little flat base, who knows, this could actually turn out and break out. Now, the caveat again is the relative strength line has been weak since we've been correcting a little bit in the stock, and it could be rolling over. So it's a caution sign. Who knows, the chart could completely break down, or maybe it continues to build a base and then it breaks out. Another stock that's been fairly strong in the market has been Sweetgreen SG. You can see its last earnings report had a nice gap up. We had this nice high volume close here. The stock has been kind of going sideways, just digesting that. Today, it's actually pulled down and sitting right on the high volume close and the 20 EMA. I would expect it to get some support. HIMS, this is another one that has been a pretty good move over the last 2 weeks, even though the market underneath the surface has not been strong. The strong has had a nice move up. So it's just a leader to keep our eye on. It's certainly not in a buyable position today, but we want to keep our eye on that stock. So that's just a few ideas maybe for your watch list. So now let's get out of the chart mode, and we will go back to our main slides. Okay, we're back to the main slides. So let's go to wrap this up for this week. So our summary this week is indexes are making new highs, but the participation is poor and it's weak. We're still above the 20, and the S&P is above the 20. So, in fairness, the indexes do look really good, but a sharp chart reader sees other things. So it's a very weak picture relative to new highs. We have a market making new highs, yet the new high, new lows look really, really weak. Leading stocks, the leadership is thinning. NVIDIA, the semis are dominating, but if that seems to be the one sector outperforming, it's outstanding if you're in it. But when that one pulls back, we could see a sharp correction in the entire market. Unless this is a big unless we see rotation, money coming out of semis, and if we see it rotating into other technology groups, that would be positive to support maybe a shallow pullback or a correction. If the money is leaving the market, we could correct more sharply. Exposure levels, I've left them the same, 20 to 30%. And when I say 20 to 30%, I really believe that means you're holding stocks that you have good cushion in, of at least 30%, because you're going to have to withstand some chop, withstand some pullback. Given the market environment as I see it right now, it's not a time at all to be initiating any new positions. If you're a position trader, the conditions are not right, and it tends to be a risky, vulnerable market, in my opinion, right now. So the chart of the week, the quote of the week is from Richard Wyckoff. The market always tells you what to do. It tells you get in, get out, move your stop, close out, stay neutral, wait for a better chance. All these things the market is continually impressing upon you. And you must get into the frame of mind where you are in reality taking orders from the action of the market itself, from the tape. A lot of words of wisdom in this, and it really backs up what I've been talking about. The market conditions, at least as how I see them, they don't look very good right now. Therefore, I'm taking my marching orders from the market. Those of you interested in the next Boston IBD meetup, we have our annual Rose and Thorn, and that's when we share post-analysis of trades. Members from the group will share their trades. If you're interested, I posted it on my X feed, and if you want to, you can just go to meetup.com and search Boston IBD meetup, and you can sign up for the event on the 25th of June. Another reminder, if you're interested at all about Rain King Insights, just send me an email at support@rainkinginsights.com, and I'll get you on kind of an early bird list. And within a couple of weeks, we'll be sending out a special offer with a coupon if you want to join the site. So that's a lot of information, but that's the general market update for June 14th, 2024. Have an awesome weekend, everybody, and we'll be back at it next week.